All right, so this analysis report makes a strong case for BWX Technologies as the ultimate defense stock for 2026.
Yeah, it's arguing for a pretty aggressive price target of $250.
It is. It's built on its naval defense monopoly and these, commercial nuclear tailwinds. Let's just dive right into the nuclear boom thesis here.
Okay?
So what I like right off the bat is how clearly it establishes the moat.
The non-negotiable role in U.S. submarines and aircraft carriers.
Exactly. The report makes it clear that the government's spending here is, well, they call it sticky.
And it is. That gives a rock-solid base to the whole defense side of the argument.
It really does.
And I thought the use of hard data was compelling right from the start. I mean, that 29% year-over-year revenue surge.
And the record-breaking $7.4 billion backlog.
Right. That immediately anchors the boom part of the thesis in, tangible future guaranteed earnings.
It's a powerful way to start. It tells you this isn't just a story stock.
Not at all. It's translating to actual cash flow.
Absolutely. And when you compare that 29% growth to the, single-digit performance of its competitors?
It's a phenomenal hook, no question.
But that incredible growth rate, it immediately forces us to confront the biggest issue in the whole report.
The valuation.
The valuation.
Yeah, that's the real challenge this analysis has to overcome. Let's look at how it discusses the market pricing.
So the analysis correctly points out the risk. I mean, BWXT trades at a staggering price-to-earnings ratio.
It's about 53x, right?
Yeah, around 53x. To put that in perspective, this thing is trading like a software company.
Not like a company making nuclear reactors for the Navy.
No. I mean, traditional defense stocks are usually in the, 18 to 22x range?
If that. So the report says the market is pricing it like a high-growth tech stock.
Which is true, but just flagging that risk, it's not enough.
No, it doesn't explicitly connect the growth story to the multiple expansion needed to sustain it.
Especially when you're arguing for another 40% upside to hit 250.
You can't just describe the dragon, you have to slay it.
And I think that gets to the first major point of feedback here. The analysis must more robustly justify that extreme valuation premium.
It has to bridge the gap between its current PE and its peers.
But I wonder if we've really considered the quantitative burden of that 53x multiple.
How do you mean?
Well, the weakness is that the report stops short of truly neutralizing that critical counterargument. It just states it.
Right, so the way to fix this is to build a forward-looking earnings bridge.
Okay, explain that.
The analysis has to clearly show why the market is justified in pricing it like a tech company instead of just saying that it does.
So you need the proof that the growth actually brings that multiple down to a sensible level pretty quickly.
We need concrete math.
Okay, give me an example.
For starters, you should project a PE ratio for 2026 or 2027.
Based on the double-digit growth and the forecasted 2025 EPS of around 375.
Exactly. You need to show the reader what that PE drops to if, say, 2026 EPS hits a specific number. Let's call it 450.
And then you compare that new forward-looking multiple to the peer group?
Yes. Because if your 2026 forward PE is still like 40x, then your justification needs even more support.
You have to talk about the quality of those future earnings.
And I'd add something else here too. This is the perfect place for a sensitivity analysis.
Okay.
You have to quantify how much of that massive $7.4 billion backlog is based on cost-plus contracts versus the higher margin segments.
Ah, that distinction is absolutely vital for the valuation argument.
It's everything. Cost-plus contracts give you stable revenue. That's the moat.
But they kill margin expansion.
And margin expansion is exactly what justifies a 53x multiple.
So you have to quantify the expected shift away from that stable revenue toward the commercial and medical segments that actually deserve that premium.
That breakdown is what explains the market's enthusiasm.
Right. That emphasis on the quality of the revenue, not just the quantity, that's the analytical rigor we need to see.
And that leads us right into the next issue, which is the $250 target itself.
Okay, I can see what the report is going for with the ultimate defense stock title, but to really make that claim,
You need to establish a proprietary price target. You can't just rely on Wall Street upgrades.
the report attributes the 250 target to Bank of America and BTIG.
Right, and citing them adds credibility. It shows Wall Street is waking up.
But for a strong buy report that calls itself the ultimate, relying on external targets just weakens the originality.
It makes it feel like the analysis is following the market to that 250 number, not leading the reader there.
Yeah, if I agree with your thesis, I shouldn't need BOFE to tell me what the stock is worth.
So the core weakness here is a lack of ownership over the final valuation.
I think the way to improve this is to introduce a differentiated valuation model.
Or a non-consensus driver that provides a unique path to 250 or even beyond that. Something separate from the institutional reports.
You have to own that target and the mechanics that get you there.
And this requires being really specific about the financial levers.
So you need to detail what quantitative metric is going to drive that 40% upside.
Is it the medical isotope contract scaling up faster than expected? Is that what drives an immediate margin increase?
Or is it something with the small modular reactor tech, the SMRs? Successful deployment driving margin expansion there?
You have to pick your driver and quantify it.
I think the most creative and actionable suggestion here is to perform a sum of the parts valuation, an SOTP.
That fits this company perfectly. It's clearly a collection of 3 very different businesses under one roof.
And that model can unlock value the market might be missing.
That's the key. An SOTP model recognizes that different business units deserve different multiples.
Right, based on their growth and margin profiles.
So you'd break out the high-margin medical isotopes and the high-growth commercial SMR segment.
And you'd assign them a tech-like multiple, say 30x PE, maybe even higher depending on their potential.
And then you take the massive, steady naval monopoly segment, the moat, and give it a traditional defense multiple, maybe 20x.
And you sum the parts. You have to show how your calculation, based on your internal assumptions, justifies that 250 bull case.
That proprietary work is what validates the ultimate defense stock claim. Citing Bank of America just doesn't.
And the great thing about the SOTP model is that it also inherently addresses our third big point.
The integration of the growth drivers.
Exactly. Okay, so a key theme in this analysis seems to be this shift away from just defense revenue into these higher margin commercial areas.
Right, the naval defense, the commercial nuclear and SMRs, and the medical isotopes.
The presentation of those 3 drivers needs a clearer synthesis to explain the overall growth, and really why the market is giving it a 53x multiple.
That makes sense. Right now they're presented as, sort of, separate pillars.
Submarine priority, energy shift, medical isotopes.
Yes, but without really exploring the synergy or, more importantly, the different impacts they have on the company's financials.
Especially on its margins.
Crucially, on its margins. As it stands, it's not totally clear which segment is actually responsible for that tech-like 29% revenue surge.
The weakness here is that just listing the 3 pillars doesn't show the reader how the fundamental character of the company is changing.
So the analysis needs to refocus. It needs to integrate those drivers and quantify the shift in the revenue mix over time.
To demonstrate how these growth segments are transforming BWXT from a stable, defensive contractor
into a diversified, high-multiple nuclear tech player. That's what validates the nuclear boom thesis.
We absolutely have to see the margin story. We keep coming back to this, but the 53x multiple is about the quality of earnings, not just the volume.
And since medical isotopes are described as a high-margin revenue layer,
you have to model the future impact of that scaling on the company's overall operating margins.
Yes. Compare the margins of the non-defense segments to the traditional defense sector margins.
Put them side by side.
Exactly. That comparison showcases the real high-growth earnings power that's needed to justify that PE.
If the margin profile of the new segments is way better, that's the reason the market is giving it a premium that rivals, Amazon or Google.
To be very concrete here, you have the data, the $866 million quarterly revenue surge, and the 29% growth figure.
You have to analyze that growth by segment.
Estimate or project what percentage of that 29% was driven by the high-margin medical and SMR segments versus the standard naval reactor work.
That segmentation is what turns this from descriptive reporting into sophisticated financial modeling.
And it provides the context for that extreme valuation.
It really comes down to proving that BWXT is earning this high multiple by fundamentally changing the quality of its revenue base.